Welcome back to Synaptic Dividends. We break down a new dividend stock every single week to help you build your passive income portfolio. If that's your goal, make sure you're subscribed so you don't miss out. Now, today we're tackling a giant in the defense industry, General Dynamics, and we're asking a big question. Is this company's dividend an impenetrable fortress for your portfolio? Let's look at the numbers.
Okay, so let's just think about this for a second, because this is really the core of what we're digging into today. We're talking about almost 3 decades of raising the dividend year after year without a single interruption. That streak has survived the dot-com bust, the 2008 global financial crisis, and the COVID pandemic. So the question is, how is that even possible? Well, it all comes down to a few key numbers that really pull back the curtain on the company's true financial strength.
So first things first, and honestly, the most important pillar for any dividend stock you're looking at is safety. Forget all the fancy accounting terms for a minute. What we really truly care about is cold, hard cash. Is the company generating enough actual cash to easily pay its shareholders and still have a nice big cushion left over? That's what we're about to find out. Now, the tool we use for this is called the free cash flow payout ratio. The easiest way to think about this is like your own personal budget. Your free cash flow is your paycheck after all your non-negotiable bills are paid. Rent, utilities, the basics. And the dividend? That's like a chunk of money you've committed to putting into savings every month. This ratio tells us what percentage of your leftover cash is going to that savings goal. You definitely wouldn't want that to be 100%, right? You need breathing room. Let's see how much breathing room General Dynamics has.
And here are the numbers for the last 5 years. The first thing that just jumps right off the page is how consistent this is. These numbers are incredibly stable, just hovering right around that 40% mark. The highest it got was just a hair over 48%, and the lowest was under 38%. These are what I would call incredibly healthy numbers. Generally, anything under 60% is considered safe, so to be consistently this low is just a fantastic sign of financial strength.
So here's the bottom line. The 5-year average FCF payout ratio is just 41.3%. Let me put that another way because this is really important. For every single dollar that General Dynamics pays out to its shareholders as a dividend, it's actually generating more than $2 in pure cash profit. That is a massive, massive margin of safety. It means they have more than enough cash to cover the dividend, reinvest in growing the business, and handle any unexpected problems without even breaking a sweat.
Okay, so we've established that the dividend is safe. That's the foundation of our fortress. But a safe dividend that never gets any bigger isn't all that exciting, is it? So for our second pillar, we need to see a track record of consistent growth. Does the company actually have a history of rewarding its shareholders with regular raises?
Oh yeah, the answer is a huge, emphatic yes. General Dynamics has increased its dividend for 28 consecutive years. This officially makes it a Dividend Aristocrat. That's a pretty exclusive club for S&P 500 companies that have at least 25 straight years of dividend growth. You see, for them, this isn't just some casual company policy, it's clearly a core part of their identity.
Now, what I think is really interesting when you look at these growth numbers is the type of growth it is. See, we're not seeing these wild, unpredictable double-digit swings. What we're seeing instead is this disciplined, predictable, mid to high single-digit growth year in and year out. That 8.7% average growth over the last decade, that's fantastic. It tells you that management isn't just winging it based on one good year. They have a long-term plan and they deliver these steady raises like clockwork.
All right, so the dividend is safe and it grows consistently. But what happens when the whole world seems to be falling apart? That, my friends, is the ultimate stress test. Any company can look good when the market is going up. We need to see how this dividend held up during the worst economic crises of our lifetimes.
Let's start with the big one, 2008, the global financial crisis. The entire financial system was, and I'm not exaggerating, on the brink of collapse. Major banks were failing, credit markets totally froze up, and hundreds of rock-solid blue-chip companies were forced to slash their dividends just to stay afloat. It was absolute chaos for investors.
So with the world economy basically in a meltdown, you have to ask the question that every single shareholder was asking back then. Did General Dynamics cut its dividend? Did they maybe even just freeze it to hang on to cash?
They didn't just maintain it. They didn't just keep it flat. They increased it by a staggering 21.8%. Just let that sink in for a moment. While other companies were literally fighting for survival, General Dynamics gave its shareholders a massive raise. This just perfectly illustrates the power of their business model. Government spending on national security doesn't just stop during a recession.
Okay, but you could argue one crisis might be a fluke. So let's fast forward to 2020, a completely different kind of crisis. A global pandemic that shut down entire industries, absolutely shattered supply chains, and threw the entire world into a whole new kind of uncertainty. So what about this time?
Faced with these unprecedented lockdowns and economic turmoil, did they finally have to break that incredible streak of dividend growth?
Nope, not even close. They just calmly delivered another solid dividend hike of 5.9%. This performance, during two completely different types of global crises, proves that the resilience of this dividend is not an accident. It's a feature. It is built right into the structure of the company. So after looking at the safety, the growth, and that battle-tested history, we can bring it all together for the final verdict. What are the numbers really telling us about this dividend?
At the end of the day, it really comes down to these three pillars. First, the cash flow cushion is huge, with that payout ratio sitting comfortably around 40%. Second, the growth is incredibly reliable, with a 28-year track record to prove it. And third, it has passed the ultimate stress tests, proving its strength when it mattered most. Together, these really do form the walls of a true dividend fortress.
The numbers really don't lie. This isn't just some line item in a budget for them. The commitment to paying and growing this dividend seems to be woven into the very DNA of the company. The safety, the consistent growth, and the proven resilience, it's all there in the data.
If you want to go deeper and understand the full business model behind these numbers, check out our deep dive analyses on our main channel, Synaptic Investing. And of course, if you found this breakdown helpful, a like is always appreciated and subscribe for more dividend analyses. Thanks for watching.